If you wish to comprehend the nature of this endeavor in speculation, know this. Its principles are straightforward, but their mastery is a difficult path. This is the very truth that eludes most men. The market tape will paint 1,000 pictures for you in any given week, should you choose to hunt for them. But how many of these pictures are worthy of your capital? How many justify the inherent risk? Therein lies the true art of the game. Speculation is not the act of swinging at every price movement the market presents. It is the discipline of standing aside, observing, waiting, and only committing when the forces have aligned so decisively in your favor that to abstain seems the greater folly. Have you ever felt that internal pressure to act simply because prices are in motion? That is the crucible where discipline is forged. It is where the majority of men find their ruin. I have dedicated years to learning this lesson through the costly school of experience. I accumulated capital and saw it vanish, only to repeat the cycle again and again. This pattern persisted until I understood that the only ventures worth undertaking were those where the primary trend served as my tailwind, where the mathematical probabilities were so heavily weighted on my side that the potential for loss was dwarfed by the opportunity for gain. Do you grasp the distinction between acting from eagerness and acting because the conditions are truly mature? Most do not. They enter the market for the sake of participation, as if holding a position were a badge of honor. But the astute speculator knows that standing aside is also a position. Patience is a position, and it is frequently the most profitable one a man can take. You may wonder what constitutes a high probability condition. It is not found in some mystical formula or a secret mechanical indicator. It is the confluence of market factors that decisively tilts the balance of power. Imagine yourself at a card table. You do not wager on every hand dealt. You patiently await the hands that offer a statistical advantage. A high probability formation is that decisive advantage. It is the harmonious alignment of price movement, the major trend, trading volume, and market sentiment, arranged in such a way that the market itself seems to declare its next major move. But I ask you, when you study a chart, are you observing the facts as they are, or are you projecting upon it the outcome you desire? This is what separates the speculator from the common gambler. The market is a relentless teacher, provided you are a willing student. The action of the tape speaks with more authority than any opinion. It leaves clues in every fluctuation, every price bar, every reaction to news. A stock that refuses to decline on negative reports is communicating a fact. A stock that advances on significant volume and holds its gains is communicating a fact. Are you listening to these facts, or are you preoccupied with the narrative you're telling yourself? This is the test, and it is a test you will face every single day you engage with the market. The greatest challenge in speculation is not finding profit, but preserving capital. For timeless guidance, we turn to the foundational work of William Delbert Gann, his 1923 text, Truth of the Stock Tape. This essential volume lays out 24 immutable rules for market success, emphasizing that the mastery of money management and correctly determining the major trend are the keys to longevity. Find the link to this indispensable wisdom in the description below. When I speak of high probability conditions, I refer to moments when the path of least resistance is made evident by the preceding action. A breakout following a prolonged period of consolidation is a prime example. Why is this significant? Because when prices have paused, absorbed previous moves, and exhausted both the bulls and the bears in a narrow range, the first decisive move out of that range is typically the true one. The market has been building a cause, and now it is prepared for the effect. Does it not stand to reason that one should place their wager on the release of energy after observing it being methodically built? Yet many traders plunge in before the move, guessing, hoping, and attempting to will the breakout into reality. They are then left to wonder why the stock stagnates and they are whipsawed. The high probability approach is to await confirmation of the move and then act. Wait for the proof. Acquiring proof in the market has a cost, yes, but it is far less expensive than the price of acting on hope. Another hallmark of a high probability opportunity is the trend itself. Trends exist for a reason. The majority of capital has committed to a single direction. To fight this force is an exercise in futility. If a stock is in a defined uptrend, creating a pattern of higher highs and higher lows with volume confirming the advances, does one need a fortune teller to suggest which side to favor? And yet time and again I observe men attempting to call the exact top, predicting reversals and wagering against clear strength because they cannot bear the idea of joining a move already in progress. But which is the greater error? Being slightly late to a correct position or being fundamentally wrong? Experience has taught me that the market rewards patience generously, but it penalizes vanity without fail. When you study your chart, ask yourself, do you see the footprints of the large operators? Because that is the trail you are meant to follow. The public does not initiate major price moves. The public reacts to them. It is the large interests, the professionals, and the institutions that leave their mark in the volume and structure of the market. When a period of accumulation is in progress, the tape will show it. When distribution is underway, the evidence will be there. Are you searching for these footprints, or are you merely gazing at price bars without comprehending their meaning? A high probability setup is little more than aligning your own small force with the overwhelming force of those stronger than you. It is allowing the tide to carry your vessel rather than attempting to row against it. Risk, naturally, is the inseparable counterpart to this equation. No trade is a certainty. Every commitment of capital carries with it the possibility of loss. This is why the intelligent speculator always quantifies his risk before he commits his funds. A high probability setup is not merely about the potential reward, it is about the ratio of that reward to the risk assumed. If you stand to gain 3 or 4 times your potential loss, and the chart action supports the thesis, that is a venture worth considering. But if you are risking $1 to potentially make 50 cents, I ask you, is that a sound proposition? It is not. That is not speculation. It is a donation of your capital to the market. Would you accept such terms in any other line of business? Of course not. Why, then, should you accept them here? In speculation, your own mind is your most formidable adversary. It urges you to act when you should be patient. It fills you with fear when the situation calls for courage, and it fills you with boldness when caution is required. How many times have you watched a stock advance steadily, only to convince yourself that the move is over? Then you finally enter just as the true top is being formed. Or you observe a stock declining, you tell yourself it has become a bargain, and you buy, only to see it become a greater bargain still. This is the pull of human nature, and it is the very force you must learn to master. High probability conditions do not require you to chase or to guess. They will present themselves to you if you cultivate the patience to await them. The market, in its very essence, is a mechanism for weighing human emotion. Hope and fear pull prices in one direction and then the other. But beneath these emotional currents lie patterns that repeat, for the simple reason that human nature itself is constant. Have you not observed how the same chart formations manifest time and again, regardless of the decade or the stock being traded? The names of the players may change, but their emotional weaknesses do not. A breakout from a base appears the same today as it did in 1905. A failed rally exhibits the same characteristics now as it did when I first learned to read the tape. This is why the study of charts is not a superstition. It is the study of human psychology, rendered in the clear language of price and volume. Let me impart something of importance. The great fortunes are not made in capturing minor fluctuations. They are made in the great campaigns, the major moves where you align yourself with a powerful trend and remain with it for the duration of its run. High probability setups are your points of entry for these campaigns. You do not build wealth by scalping for fractions here and there, exhausting your mind and paying commissions to every broker. You build it by identifying when a market is poised for a substantial move, and then possessing the courage and patience to stay with it. Do you believe the great industrialists built their empires by selling their holdings too soon? They did not. They held, they accumulated, they allowed the trend to pay them, and that is precisely what the speculator must learn to do. Still, the impulse to take a small, quick profit is powerful, is it not? You see a stock up a few points, and your instinct is to secure it before it disappears. But in doing so, you deprive yourself of the very large gains that are meant to pay for all your small, inevitable losses. Do you realize how few truly high-probability opportunities you will encounter over the course of a year? Why squander them by cutting them short? A speculator must learn to differentiate between random noise and the true signal, between the ordinary daily wiggles of price and the significant moves that build wealth. When you are in a valid setup, let it mature. Protect your position with a stop, certainly, but give the trade room to breathe. High probability does not mean the absence of drawdowns. It means the odds are in your favor if you allow time and the trend to do their work. And yet, how often have you seen a man leap from one system to the next, one method to another, perpetually seeking a perfect, infallible formula? Such a thing does not exist. The secret, if there is one, lies in adhering to sound, timeless principles and applying them with unwavering consistency. Have you mastered patience? Have you trained yourself to await only the most favorable conditions and to ignore all the rest? Or are you still chasing every flicker on the tape as if your livelihood depended on constant action? I tell you, the market will consume the man who cannot control his own impulses, but it will richly reward the one who knows when to remain on the sidelines and when to act with decision. Money management is an integral part of this discipline. Never risk so much on a single venture that an error of judgment can cripple your account. Even a high-probability setup can fail. This is a fact of the market. That is why the wise speculator risks only a small percentage of his capital on each attempt, but stands ready to press his advantage when the market proves his judgment correct. Do you pyramid your position, adding to it as the trade moves in your favor, or do you treat every entry and exit as a random gamble without structure? This is the difference between professional speculation and mere betting. A high-probability setup is not just about the entry point. It is about how you manage the position, how you add to it, how you defend it, and ultimately, how you allow it to pay you. Think of your trading as you would any business. Would you open a retail store without a clear understanding of your costs, your profit margins, and the demand for your goods? Of course not. Why, then, would you trade without a clear understanding of your risk, your price objectives, and your statistical edge? A business survives because it seizes opportunities that offer a favorable return and avoids wasting capital on ventures with poor prospects. Speculation is no different. Every dollar you risk is your inventory. Every setup is an opportunity to deploy that inventory. Would you stock your shelves with second-rate merchandise? If you would not do so in commerce, why do so in the market? High-probability setups are your prime inventory. Reserve your capital for them. I will share another truth with you. The crowd is almost always wrong at the major turning points. This is why the majority of participants do not profit from the market. They buy at the tops when buying feels safest, and they sell at the bottoms when selling feels most urgent. A high-probability setup often materializes just as the crowd has become most convinced of the opposite outcome. Are you willing to buy when the prevailing emotion is fear? Are you willing to sell when greed is rampant? That is the ultimate test. But you do not act on this principle blindly. You act because the chart, the volume, and the behavior of the price itself tell you that the tide is turning. This is not contrarianism for its own sake. It is intelligent speculation based on evidence. What you must cultivate is a mind that sees the facts clearly and waits with immense patience. Do not clutter your charts with 100 different indicators. Do not drown yourself in the flood of news and opinions. Concentrate on the essentials: price, volume, trend, support, and resistance. That is all you require to identify high probability conditions. Everything else is a distraction. Do you imagine the great operators of my time required 10 oscillators to tell them when to buy a stock? They did not. They read the tape. They studied the action. They knew from the evidence when the market was strong and when it was weak. Keep your methods simple. Keep your mind sharp. Keep your focus unwavering. And above all, remember that this game is not about being correct on every single trade. It is about being correct on the significant ones. You can be wrong half the time and still accumulate a fortune, provided your winning trades are substantially larger than your losing ones. That is precisely why high probability setups are so crucial. They tilt this mathematical balance in your favor. They help ensure that when you are right in a meaningful way. And when you are wrong, the damage is contained. Is that not the very definition of sound speculation? A breakout after a long consolidation is one of the most reliable and powerful setups you will ever encounter. And yet most traders either fail to recognize it, misuse it, or lack the patience to wait for its proper development. The market is a rhythm of movement and rest, of expansion and contraction. It does not move in a straight line indefinitely. It advances and then it pauses. It runs and then it digests its gains. That period of pause, that congestion where prices trade in a narrow channel and seem to go nowhere, is not dead money. It is a period of preparation. It is the quiet that precedes the storm. The longer a stock builds its base, the more powerful the subsequent breakout tends to be. Does this not appeal to common sense? Pressure builds, energy is stored, and when that energy is finally released, its force is greater. This is why a confirmed breakout after a period of consolidation is far more trustworthy than a premature entry based on guesswork. The first thing to understand is the reason for consolidation. A stock advances and then encounters selling from those taking profits. Early buyers cash out, while newcomers hesitate to chase the price higher. Short sellers may test the stock's strength. The result is that the price settles into a trading range. Volume typically recedes. The stock appears dull, and this very boredom is what drives out the impatient traders. But below this placid surface, strong hands may be quietly accumulating shares. They use the quiet period to absorb the available supply from weaker holders. They build their position without causing undue alarm or attention. Can you envision what occurs when they have finally acquired their desired line of stock? When the sellers have been exhausted, and when the shares are now in firm hands? The slightest increase in demand can then send prices upward sharply, for there is very little stock left to be sold at the lower levels. That is the mechanics of a breakout. Now most traders will not wait for confirmation. They see a stock approaching the upper boundary of its range, and they rush to buy, hoping to get in at the very beginning of the move. But hope is a poor substitute for strategy. How many times have you entered just before a breakout, only to see the stock retreat back into its range, consuming your capital and your confidence? That is the trap of anticipation. High probability speculation demands proof, and that proof comes at a price. Yes, you may pay a slightly higher price by waiting for confirmation, but what you are buying is a greater degree of certainty. Would you rather pay a premium for evidence or a discount for hope? This is the decision that distinguishes the professional from the amateur. A confirmed breakout is not merely a brief poke above a resistance level. It is a decisive move supported by a clear increase in volume and sustained beyond the day-to-day noise. Volume is the key, for it reveals the conviction behind the move. If prices rise but volume remains anemic, the breakout is suspect and may be false. But when prices surge and volume expands dramatically alongside them, that is the market speaking with a clear voice. That is demand decisively overpowering supply. Do you see why volume must be the constant companion of price in every significant move? To ignore it is to trade at your peril. Consider the psychology of the participants who were trapped within that consolidation range. Every trader who bought near the top of the range is now eager to sell at break-even. Every trader who sold short near the bottom is hoping for a decline. When the breakout occurs with force, those short sellers are compelled to buy back their shares to cover their positions, adding more fuel to the upward move. Those who hesitated, those who sold out too early, and those who doubted the move all rush in to buy. This chain reaction, this forceful unwinding of old positions and establishment of new ones, is what gives a true breakout its power. You are not just buying strength. You are buying the forced buying of others. Is that not precisely the kind of powerful current you wish to ride? The duration of the consolidation is also a critical factor. A base that has been built over many weeks or months carries far more significance than one formed over a few days. Why? Because time has a way of wearing out the impatient. The longer a stock remains quiet, the more weak hands will give up and sell. The more complete the process of accumulation by strong hands, the more explosive the eventual breakout. When you see a stock that has done nothing for months and then suddenly pushes through resistance with authority and volume, you are witnessing one of the most powerful formations in the market. How many traders ignored it during its long slumber? How many were shaken out by sheer boredom? And how many will now scramble to get in when the move is already obvious to everyone? Your patience is rewarded by their haste. But remember, not every breakout will follow through. The market is a master of deception. False breakouts are common, and they are designed to punish the greedy and the undisciplined. How do you protect yourself? You insist on confirmation. You scrutinize the volume. You place your protective stop intelligently. A genuine breakout should not immediately collapse back into the old trading range. If it does, you must accept the evidence and cut your loss without emotion or hesitation. The elegance of this setup is that your risk is clearly defined and usually small. Your stop can be placed just below the breakout point. If the move fails, you are out with a minor loss. If it succeeds, the potential reward can be many multiples of the risk. That is the textbook definition of a high-probability trade. Now consider this within the context of the overall market. Breakouts that occur in a strong, broad market have a much higher probability of success than those that try to emerge against a weak prevailing tide. A stock breaking out during a major bull market will likely attract more capital, more enthusiasm, and more institutional sponsorship. Conversely, a breakout in a bear market may struggle to gain traction. Do you align your ventures with the major tide, or do you attempt to fight it? The answer to that question can determine whether your breakout becomes a source of fortune or frustration. There is also the matter of relative strength. A stock that demonstrates strength while the general market is weak, one that holds near its highs while other stocks are declining, is a prime candidate for a breakout. It is telling you that something powerful is occurring beneath the surface, that demand for this particular stock is outweighing supply even in unfavorable conditions. When the general market finally turns upward, such a stock is often the first to break out, and it tends to run the farthest. Are you paying attention to the stocks that resist the general decline? They are the future leaders, waiting for their moment. A confirmed breakout is not merely an entry signal, it is often the start of a new campaign. This is where real wealth is constructed. Too many traders snatch a quick profit after the initial surge, but the seasoned operator understands that the first move is often just the beginning. The breakout signals that a new major trend may be underway, one that could persist for weeks, months, or even longer. If you sell out too soon, you rob yourself of the very large profits that are meant to justify all your patience and your small losses. Is it not more logical to ride the wave for as long as it continues, perhaps pyramiding your position carefully as the new trend proves itself, rather than grabbing a few points and immediately seeking the next fleeting opportunity? That is how great fortunes are made. Let us speak for a moment on the subject of discipline. Waiting for a breakout after a long consolidation will test your patience more than almost any other scenario. Other stocks will be moving. the market will seem to be leaving you behind. But discipline means waiting for your specific pitch, not swinging at every ball that crosses the plate. A consolidation can last much longer than you anticipate, but when it finally resolves, the reward for your patience is often immense. Can you stand to watch and wait without forcing a trade? Can you accept the periods of boredom as the price of admission to a high-probability move? This is where your character as a speculator is truly revealed. You may notice that some breakouts fail precisely because they are too obvious. When every chart watcher sees the same resistance level and they all try to pile in at once, the market often has a way of punishing the crowd. This is why a degree of subtlety is valuable. The best breakouts often occur in stocks that are not on everyone's daily watch list, in bases that appear dull and uninteresting to the average eye. By the time the public takes notice, the professionals have already established their positions and the major move is well underway. Are you hunting for these overlooked opportunities, or are you chasing the same stocks everyone else is watching? The former requires more work, but it pays far better. Risk management, again, can never be overstated. You never assume that a breakout will succeed simply because the pattern looks correct. You always define your risk, place your protective stop, and fully accept the possibility of failure before you enter. The high probability setup does not offer a guarantee of success. It only tilts the odds in your favor. That tilt is all a professional needs, provided he manages his capital correctly. A series of small, controlled losses offset by one or two major breakout campaigns can build an account steadily over time. Do not fear being wrong. Fear staying wrong. When you study historical charts, you will see this pattern repeat in every era. Consolidation, breakout, trend. It is the fundamental rhythm of the market, the very heartbeat of speculation. Whether it was the railroad stocks of my day or the technology stocks of yours, the underlying principle remains unchanged. Human nature creates the trading range, human impatience causes traders to give up during the wait, and human greed and fear fuel the eventual breakout. That is why this setup has stood the test of time. Do you believe it will ever cease to work? Not as long as markets are driven by people, for people themselves do not change. The lesson is simple, but it cannot just be learned. It must be lived. You must train your eyes to recognize the bases, your nerves to endure the wait, your discipline to demand confirmation, and your courage to hold on once the real move begins. This is not easy work. It is far more difficult than chasing every minor price flicker, but it is the work that leads to profit. If you call yourself a speculator, then mastering the breakout after consolidation is not merely an option, it is an essential skill.